You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of timely topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this series. And in today's conversation, we're going to explore the latest Conference Board CEO Confidence Survey and how business leaders around the world are reacting to what is really an historically complex period of time and precarious combination of challenges facing the global economy. Joining me today is Lynn Franco, our Senior Director of Economic Indicators and Surveys at the Conference Board. Lynn, welcome.
Great to be back, Steve.
Okay, so Lynn, the Conference Board does the CEO Confidence Survey every quarter. It's a really important one because these CEOs run some of the largest companies in the world and collectively, deal with tens of millions of jobs. So what does the latest survey tell us?
Well, unfortunately, it's not very good news. What we've seen is this downward trend that we've been experiencing over the last several quarters has continued. CEO confidence is now at 32 to start Q4. That's down from 34 last quarter. And to sort of put it in a historical perspective, we've actually fallen now into very deep negative territory, which we haven't seen since the depths of the Great Recession. So again, we're sort of at these recession levels and CEOs are quite pessimistic.
Yeah, so what does this 32 mean? I mean, 50 is sort of the threshold between positive and negative, right?
Absolutely. And for some sort of historical perspective here as well, too, is back in Q2 of 2021, we were at an all-time high of 82. So you can see that we've sort of taken an about face, and we're now sort of at levels that we only see during a recession.
Yeah, and so that's worrisome. So what percentage of the CEOs in this survey are saying that the U.S. is going into a recession?
Well, Steve, we've got an overwhelming majority of CEOs saying that we're going into a recession. 98% said they're preparing for a recession in the U.S. over the next 12 to 18 months. And I think that also aligns quite well with our own forecast, where we see the U.S. falling into a recession, Q4, potentially into Q1 of 2023. On the bright side, if there is one regarding recessions, is that we expect it to be sort of, short and shallow.
Yeah, and that's what we're hearing from CEOs. This 98% number is just astounding. I don't think that we could get 98% of CEOs to agree that the sky is blue, but you've got, almost 100% consensus here that the U.S. is going into recession. Now, they point the blame, and the reason that they feel that this is going to happen is a lot due to the Fed, right?
Absolutely. We're seeing that, top of the line challenges remain: interest rate hikes, inflation, supply chain constraints. So these are really sort of dominating the conversation and are likely to do so well into 2023.
Now, that we've been talking about the U.S., what do they say about Europe and the prospects there?
Well, the prospects in Europe are not much brighter. 99% of CEOs said that they're preparing for a recession in the EU. However, 7 out of 10 expect a very deep recession with sort of material global spillover. And I think we're seeing echoes of this in some of our global leading economic indicators. For instance, Germany, EU, UK, there's sort of a lot of red flags here that this region in particular is going to tip into a recession and quite soon.
Yeah, so they're saying that the EU is going to have a deeper recession than the US will have. Now, part of that's due to the war in Ukraine, but also due to the supply issues regarding fuel and energy. And, Russia's cut off a lot of that, the spiking costs of that. And, and other worries. So it's a different situation in Europe.
Absolutely.
Now, in China is the sort of the third big area. They're the second largest by country, the second largest contributor to GDP. What are we seeing there?
Well, I don't think we're forecasting a recession for China, but we are expecting slower growth. There are some, trouble areas, for instance, the housing market. But the two most likely regions that are going to fall into recession remain the US and Euro area.
Yeah, but CEOs are particularly concerned about, the ongoing COVID shutdowns in China, as well as supply chain issues coming out of China, aren't they?
Absolutely. And those could continue to be shocks throughout, this year and into next year as well, and could sort of, heighten some of these supply chain challenges that we continue to experience.
As we've been reporting, no two recessions are the same, of course, and this one's very strange. And we see that in these CEO confidence results, where they're still planning on hiring people and they're still planning on raises and all of that. That's really different, isn't it?
Absolutely. We're really seeing sort of these persistent tight labor market conditions. There are still some, talent shortages that are prevalent, but hiring plans for the most part remain very robust, which is not what we've seen in other recessions, and perhaps why this one's sort of being, dubbed as the jobful recession. So I think we may begin to see, and I think what our expectations are, is that coming next year, there will be some cooling in terms of hiring plans, perhaps a bit of an uptick in the unemployment rate as more of these interest rates hikes filter through the system.
Yeah, typically when CEOs see that they're going into a recession in whatever economy, let's just use the US, the natural tendency is to dial back their hiring plans because they don't want to expand and risk then having to do layoffs of those people, and they also cut spending. But what we're seeing here is that that's a different model, and that has to be partially due to this huge number of openings. It's still right around 11 million unfilled positions that the businesses are facing. So this is really a different kind of a situation.
Absolutely. I mean, close to 45% are said they still continue to, they're going to continue to expand their workforce over the coming 12 months. 68% said they're still having problems finding, qualified workers. So a lot of these issues that we've seen now for the last 2 or 3 years still persist. And in fact, wage pressures, I'd like to point out, really are prevalent here. We've got 85% of CEOs saying that they expect to increase wages by 3% or more still over the coming year.
Yeah, which is higher than what we've seen in the past, which has been closer to 2%. So it's an interesting situation, and hence the Fed has been very clear, I think, in saying that their number one goal is to reduce inflation. In other words, to take actions with quantitative tightening and raising of the discount rate in order to get that inflation level back down close to their 2% target. And they've said, we'll take the collateral damage, which includes a reduction in GDP, which is a recession, and also potentially some damage on the labor markets. But this is where the CEOs are saying, hey, maybe there won't be such a big pain in the labor market, given the tightness that we're experiencing going into it.
Absolutely. And the flip side of that is that this strength in the labor market that's still prevalent has been supporting our consumer confidence index. When we take a look at that, it seems that, over the last 2 months or so, consumers have grown a little bit more confident. They're cautious, I think, about the overall outlook over the next 6 months. So the possibility of a recession is still on their radar, but this strong labor market has really been sort of the main pillar of support for consumer confidence.
Yeah, so that's juxtaposed versus the CEO confidence. Typically, CEO confidence kind of leads, what happens. You see that start to decline ahead of a recession, but it's only when it happens that you start to see consumer confidence decline. But even consumers are saying we're going into a recession, but they're feeling pretty good. And, that's driven by their own personal situations. But that might be a huge positive because we're going into the holidays. And that means that spending could stay high. And, maybe this won't be as deep of a recession as it could be.
Perhaps. And I think the key for consumer confidence in the coming months is going to be how much does the labor market cool? Because we could see a little bit of cooling in confidence if we begin to see unemployment ticking upwards.
Yeah. Okay. So now there were some differences by industry and, their CEO's views on prospects by industry. Anything there that stood out for you?
I think what's really interesting in this survey versus the Q3 survey was back in Q3, CEOs were a little bit more pessimistic, both about the current state of the economy and expectations for growth. And they were much more, I think, or less pessimistic about industry prospects, right? So now what we've seen is sort of the industry prospects begin to weaken. So it's more in line with sort of their overall macro overview. So I think this is just, a little bit more evidence that there is a slowdown underway, and it could become a bit more pronounced over the next couple of months.
Yeah, and we all know that recessions don't hit like peanut butter. I mean, it's every industry is a little bit different. So some get hit really hard. There are cyclical kinds of industries, and then there are less cyclical industries. We still see robust increases in prices and hiring and so forth in consumer staples and those kinds of places. Energy, of course, is topsy-turvy with that situation, but demand is still quite strong. So, it's possible that some of these industries, could go through this and not really experience anything, while others, really get hit hard.
Right, absolutely. But I do think it's a little bit interesting now that we're beginning to see sort of the weakening in industry expectations as well. I'll be curious to see what happens with the next quarter's report to see if it becomes even more pronounced and much more in line with sort of the negativity that they're expressing about the overall macro view.
Yeah. Now, the other thing that CEOs talked about were their plans for capital spending, which is important because, you not only have the investment in people and jobs, but you have the investment, for long term, which is, considered capital as plant, equipment, stores if you're in retail and so forth. What are they saying about capital expenditure plans?
Well, here we have a bit of a silver lining. We've got 86% of CEOs expect to either increase or maintain their capital budgets currently versus 82% last quarter. So I think that we're not seeing a pullback or a cutback in capital spending as of yet. So that's some pretty positive news and probably a bit different than what we've seen in prior recessions.
Well, and the last huge recession was 2008, 2009, and it took a long time to recover. But that was a financial crisis. Liquidity was an issue, and so you saw capital spending and all investments really drop. So does that suggest then that obviously this is not a financial crisis? It's not driven by the same thing, so it's obviously different. But does it suggest that maybe this recession will be shorter and shallower?
That's exactly what we're forecasting. Probably 2 quarters, Q4 of this year and Q1 of next year. Brief, shallow, and hopefully not as painful as prior recessions.
With the pain being defined by, job losses and those kinds of things. So it's really interesting. Any other results, Lynn, from the CEO confidence survey that you'd like to share with us?
Well, I think, we also asked them about what challenges do they foresee their companies facing by year end. And about a third or so said the biggest challenges facing their companies were political and government instability. So I think this is something that's sort of going to persist going into 2023 as well. Energy access and energy security were sort of a distant second. And inflation and supply chain issues always seem to top the list. So there's quite a few factors at play here, but I think when you sort of take a look at what the main challenges are, it's inflation and supply chain challenges.
All right, great. Lynn Franco, Senior Director of the Indicators Program here at the Conference Board. Thanks for joining us.
Thanks, Steve. Great to be here.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent expert in their field. We'll discuss leading issues in economics, geopolitics, human capital, ESG, and more. Please share CEO Perspectives with your colleagues. I know that they're going to want to listen. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You've been listening to a podcast from the Conference Board, the indispensable ally that has helped businesses through war, recession, and economic transformation since our founding in 1916. As recent unexpected economic challenges persist, you can find the latest and most trusted insights for what's ahead on our website. Please join us on November 29th for a live global virtual briefing from our award-winning economists and other financial experts. Get the latest thinking in how to best weather the economic turbulence by registering for this free briefing at conference-board.org/topics/recession.